Over the past 20 years, China has grown at an exponential rate economically, and not a single country in the world has reached the same level as China. On the outside, this seems like China's doing well. However, Cathie Wood says that history might repeat itself, just like Japan back in the 1990s. In this video, we'll be talking about how the collapse in China is even worse than you thought. Welcome to Empire Investing, where we'll be sharing the latest in stock market news, technology, and innovative investment strategies for aspiring millionaires and billionaires. If this is your first time watching our channel, please consider subscribing to see more videos just like this. Now let's get started. China's economic growth is mostly because of its real estate. In order to spread their real estate holdings across hundreds of cities, real estate developers have taken out loans. China is full of modern glass and steel apartment buildings, office complexes, and houses. They started buying houses for the sole purpose of raising their value. Housing costs in China have been steadily rising for decades now, according to the average Chinese citizen. The rapid population growth in China was part of the reason, but the speculation went much further. In cities like Beijing and Shanghai, the majority of Chinese citizens are unable to afford a standard house or apartment due to rising housing costs. For people to afford a standard house, they'd have to purchase a property near the cities, but should at least be far enough for prices to be cheaper, which is what most of the Chinese citizens did. They went as far as 10 to 15 miles away, but since property developers have already thought about this, they have already built houses preemptively, which resulted in ghost cities, a product of property developers' speculation, thinking that the prices will increase. There are a lot of modern buildings that are now in great condition, but nobody's living there. Right now, China's real estate sector is worth $50 trillion, which is twice as much as the United States and 4 times China's entire GDP. According to Loomis Sayles, 70% of China's entire wealth is in real estate. Prices near cities are so high that despite saving up, Chinese citizens still have to rely on expensive mortgages to afford a place to live in. Given the fact that people want to have a property and avoid the fear of missing out, they're forced to take risky loans just to purchase a property. China's real estate exponential growth is already showing signs similar to what happened in the U.S. 2008 recession. Because the prices of real estate are growing at a fast rate, developers are doing everything to expand their portfolios as fast as they can. Because of their greediness, developers are now under too much debt, which usually starts a financial crisis. And this includes the largest real estate developers in the world, Evergrande. Evergrande grew their real estate portfolio to more than 565 million square meters of developed land. They used corporate bonds issued to international investors and took out over $300 billion in debt. This gave Evergrande a huge capital that made them thrive, and in 2018, they became the most valuable real estate company in the entire world. However, investors realize that Evergrande is in trouble because credit agencies have categorized Evergrande in default because they haven't repaid a $260 million interest payment. Now, international bondholders are threatening to sue Evergrande because of their debt crisis. One of the reasons for Evergrande's bond prices to fall immensely is President Xi Jinping's effort to crack down on their real estate sector. He aims to reduce the country's dependence on their real estate sector by lessening the speculation in real estate. According to Xi, his mantra is that homes are for living and not for speculation. The actions of President Xi pose a risk to the stability of China's economy. A study recently revealed that a total of 484 companies are overdue on payments in the fourth quarter of 2021, and it's only getting worse. Property developers know that China's real estate sector is increasingly getting worse, and as of December 2021, contracted sales for the top 100 real estate companies were down 35%. This marks the first year that this sector has experienced a decrease in sales for over 20 years. Cathie Wood talked about this in a recent video and explained what Sofia Horta Acosta, a Bloomberg journalist, reported. Evergrande suspends trading on the stock exchange, and the developer Evergrande was ordered, think about this, to demolish 39 illegal buildings because they didn't have the right permits. Can you imagine if that happened in the United States? The 100 largest developers in China reported that their contracted sales were down 35% in December.
And for the year as a whole, they fell. For the first time, Sophia says, in at least 5 years. I don't think I've ever seen them fall in the last 20 years.
A few of the other developers went bust. Shimao, which was rated investment grade in November, defaulted on a trust product and rocked the credit market, and the central bank withdrew liquidity.
A lot of people thought they were going to increase liquidity because they said they would. A China regulator vowed stability after stock market's rocky start.
But they haven't done anything about it yet. And very interestingly, the yuan, the RMB, the local currency, after a very strong year, held up. And I think it held up probably helped by the government, supported by the government.
It is starting to weaken. Quite a telltale sign. And one stock, Hurong, which had not traded since last March, opened this week and dropped 50%.
The Federal Reserve has also kept tabs on China's housing bubble, and they believe that this economic slowdown will affect the U.S. economy negatively as well. According to the Fed, stresses in China's real estate sector could strain the financial system, with possible spillovers to the United States. They backed up this claim by citing China's government and its local debt as the main issue. China's GDP might be growing at a fast rate, but so is their debt balance. Their debt balance is so severe that it's almost in line with developed countries in terms of percent of GDP. Having as much relative debt to GDP as developed countries is already a telltale sign that things moving forward will be negative. The Feds also cited the stretched real estate valuations and how the Chinese Communist Party is cracking down to crash said valuations. This is in reference to the 3 red lines policy that China's government is implementing on the real estate sector. This includes a liability to asset ratio under 70%, a net debt to equity ratio less than 100%, and a cash to short-term debt ratio of 1. For each red line that companies comply with, they can increase their debt level by 5% per year. This policy is reasonable, but this should have been implemented years ago. The Chinese Communist Party is playing with fire based on their new policies that they're implementing. According to Cathie Wood, this could potentially ruin the property sector completely. At least one of the red lines has been crossed by 2/3 of the top 30 Chinese developers. This is a problem because property developers cannot simply reduce their liabilities in this way immediately because they'd have to sell properties. Evergrande and Kaisa Group Holdings are doing this right now. Evergrande is selling their Evergrande Tower, which houses their Hong Kong headquarters. There's also Kaisa Group Holdings, which has put a total of 4.7 million square feet on the market. However, both companies haven't sold any of these projects because there are no buyers. The reason is because their other real estate developers are selling as well to meet the red line policies. The only viable solution to get buyers is for Evergrande and Kaisa to lower their price. However, if they lower their prices multiple times, the market will collapse. Take Evergrande's plan to offer a 30% discount for all of their properties. 30% is a huge drop, but despite that, buyers still aren't biting. Their properties are not selling as fast as they would expect and will hugely affect China's fast GDP growth. The Federal Reserve mentioned earlier that China's collapse will affect the U.S. negatively, but they also mentioned that this could also affect the rest of the world. According to them, China's economic slowdown could strain global financial markets through the deterioration of risk sentiment, pose risks to global economic growth, and affect the United States. This means that if the real estate market in China collapses, the entire global economy will suffer. This is because the world relies on China's manufacturing of almost every good. It may seem that China's economy is too large to collapse. However, based on history, it's not a rare occurrence. The real estate crash in Japan in 1989 is similar to what's happening to China right now. In the 80s, Japan was the blueprint for growing economies. It was envied by the world because of how fast their GDP was growing at an average annual rate of 3.89% in the 90s. After decades of thriving, Japan went into a huge debt crisis. Japanese corporations borrowed a lot of money after their Ministry of Finance encouraged corporate borrowing and promoted low interest rates, deregulation, and domestic stimulation. This increased the money supply by 8 to 10% per year. The prices rose exponentially alongside Japan's GDP. Despite that, their economy collapsed instantaneously. By 1992, Japan's stock market was down to almost 60%. On top of that, over the course of 2 decades, the Nikkei index dropped to 45%, which resulted in the quote-unquote lost decades since China's real estate prices did not recover for decades. And Cathie believes that China's heading in the same direction too. China's real estate prices are rising to new highs, which are caused by the increasing debt crisis, and if this continues, commodities will also be negatively affected. Which brings confusion to Cathie because despite an upcoming crash that could potentially have negative implications, commodities haven't crashed just yet. Consumer confidence is relative to commodity prices. If consumer confidence is low, the commodity prices go down as well, but consumer confidence is still relatively high. In writing, property prices are already crashing. Sales have fallen over 16% in November and 0.3% monthly in new home prices. 0.3% may not sound like a lot, but if we look at it per year, that's 3.6% decline. The deceleration of these rates has not been seen since China's economic slowdown in 2015, and Cathie believes that China's economy will slow down significantly in the next 3 to 6 months. Commodity prices are now at an alert level. Iron prices have dropped to 35%, Baltic Freight Dry Index to more than 40%, DRAM to 25%, and U.S. lumber prices to 33%. There's also WTI oil price, which declined by 12%. The real estate sector of China is in danger and will worsen over time. S&P's rating agency is expecting a 10% decline in nationwide residential sales in 2022 because of credit tightening and restrictive policies, which means that even you are also affected. That's all for today. What do you think about what's happening in China's economy? Join the discussion in the comments below. If you like the video, please click the like and subscribe button too. We'll see you guys in the next video.